PE ratio, or the price to earnings ratio, shows how much investors are paying for every rupee the company earns. A company with PE 40 or 50 is expected to grow fast, but it could also mean the stock is overpriced. However, a company with PE 5 or 6 can be a good investment as it is undervalued, but only if the company is financially strong. So, how can we strike a perfect balance to ensure that the company's stocks aren't too expensive or too cheap? Keep watching this video till the end to find out. Also, don't forget to hit the subscribe button and click on the bell icon to never miss out on any updates from us. Within the Indian market, a PE ratio falling between the range of 20 to 25 is often seen as attractive, as it offers potential for growth while managing investment risk. Tech companies tend to have higher PEs as they're expected to grow faster, while banking and steel companies tend to have lower PEs due to their slower growth rate. A good PE ratio allows investors to secure a fair price for their stocks. And if you want to learn more about a good PE ratio for your stocks, make sure to click on the blog link provided in the description. Now let's talk about how to calculate the PE ratio. To calculate the PE ratio, divide the stock's current market price by its earnings per share. The current market price is the current trading price of the stock in the stock market, and EPS is the company's profit divided by the number of shares. For example, if a company's current stock price is 500 per share and the company's earnings per share is 50 rupees, we get a PE of 10, meaning the investors are willing to pay 10 rupees for every 1 rupees the company earns. Keep in mind that to estimate the true value of stocks, PE ratio alone won't be enough. If you want to learn more about estimating the value of the stocks you invest in, make sure to check out this video.
Investments in securities markets are subject to market risks. Read all the related documents carefully before investing.